Hello dear friends, today is Wednesday, January 15. Let's look at the charts for the euro and the pound sterling and try to make some predictions. As we can see, the European currency continued its bullish run against the US dollar, driven by talk that Donald Trump could take a gradual approach to implementing a series of escalating tariffs. During the North American session, the euro extended gains and the British pound bounced off its lows, indicating the potential for a further bullish correction. The risky currencies were supported by weak US producer price data. Producer price inflation increased by just 0.2% in December, while the consensus estimate called for a 0.4% increase. On an annualized basis, the PPI rose by 3.3% against a forecast of 3.5%. Although these figures could signal a more dovish approach by the Federal Reserve, this scenario is unlikely. With the US labor market remaining resilient, the regulator will hardly be more active in cutting interest rates. Core producer price showed no growth, while economists predicted a 0.2% increase. On a year-on-year basis, core PPI remained unchanged at 3.5% in December versus a forecast of 3.8%. All of this favors risky assets and puts pressure on the greenback. Now let's take a look at today's macroeconomic calendar. It's full of important news releases that could have a major impact on market sentiment. The UK is set to release inflation data. The consumer price index is expected to rise by 0.4%, with the annual rate of coming in at 2.6%. If the data is in line with forecast, the Bank of England is unlikely to remain active in reducing inflation rates, while the UK economy is struggling in need of monetary easing. Against this background, sterling may react with heavy losses. Similar data will be released from France. Traders may also take notice of a speech from an ECB official. Later in the day, market participants will shift their focus to US statistics, particularly December consumer prices. The US inflation rate is forecast to rise by 0.4% in December after gaining 0.3% in November. Annual inflation is anticipated to edge back up for a fourth straight month to 2.9% in December from 2.7% in November, 2.7% in October, and 2.4% in September. This in turn could force the Fed to maintain tight monetary policy and refrain from cutting interest rates. Notably, markets are now pricing in the Fed's first rate cut this year in October, while a month ago they were expecting a rate reduction in the spring. Core US consumer prices are forecast to rise by 0.3% month-on-month and 3% year-on-year. In addition, Fed officials Thomas Balkin and Neil Kashkari are scheduled to speak today. Their statements are comments on inflation data and future policy moves could have a major impact on the dollar and the Forex market as a whole. If the US inflation rate comes in higher than forecast, demand for the greenback will increase, putting pressure on the euro and the pound. From a technical perspective, the 1-hour EUR USD chart shows that a false breakout 1.0282 will generate a strong buy signal. In this case, the euro will recover to 1.0324, where bears are expected to take the lead. A false breakout this mark will make it possible to sell the pair, counting on the return to 1.0282. If the price breaks through and fixes below this level, the volume of short positions will increase, with the euro sliding to 1.0245 and even 0.210. At this mark, I recommend going long on a rebound to catch an intraday correction of 25-30 pips. Long positions at 1.0245 and 0.282 can be considered on the false breakout. In a bull case scenario, if the price rises to 1.0324 and consolidates above this level, the European currency will extend gains to 0.356 and probably 0.397. However, this scenario is possible if US consumer price inflation slows. At the 0397 level, it would be wise to go short on a rebound, expecting an intraday correction of 30-35 pips. Going short at 0356 and 0324 will only be relevant in case of a false breakout. As for the British pound, it remains under pressure. Much will depend on how sterling reacts to inflation data. A false breakout at 21.94 will generate a strong buy signal, with the pound rising to 22.44 and 22.81. However, going short on the rebound will only be relevant around 23.19 in anticipation of a 35-40 pip move. Short positions at 1.2244 and 22.81 can be opened on a false breakout. Alternatively, if the price breaks through and fixes below 21.94 following the release of UK inflation data, short interest will increase, with sterling dipping to 1.2145 and hitting a new one-year low at around 20.97. At this level, traders are advised to go long on rebound to catch an intraday correction of 30-35 pips. All in all, this could only strengthen the bearish market and delay the pound's further decline. Long positions at 21.45 and 21.94 can only be considered on the false breakout. Good luck to all.